Hello. Gold is trading above $5,100 amid rising geopolitical tensions and renewed tariff concerns. The key question now is whether gold could extend its rally toward $5,500 during the week of February 23 to 27, 2026. In today's analysis, we'll break down the macro drivers behind gold's recent strength, review the technical structure, identify key support and resistance levels, and outline possible scenarios for next week. As always, this is market analysis for information purposes, not financial advice. Let's begin. Gold prices are primarily influenced by macroeconomic conditions and investor sentiment. First, inflation expectations remain a major driver. Gold is traditionally viewed as a hedge against persistent inflation, particularly when real interest rates remain low. Second, interest rates and bond yields. When real yields rise, gold typically faces pressure as investors shift toward interest-bearing assets. Conversely, falling or stable yields tend to support the metal. Third, U.S. dollar strength. Because gold is priced in dollars, a stronger USD often weighs on prices, while dollar weakness provides tailwinds. Geopolitical risk is also significant. Tensions involving Iran, trade policy uncertainty, and broader global instability tend to increase safe haven demand. Additionally, central bank buying continues to provide structural support to the market. Ongoing accumulation, particularly from emerging market central banks, has helped underpin long-term demand. Finally, overall market sentiment plays a role. Periods of uncertainty or volatility typically benefit gold, while strong risk appetite in equities can limit upside. Monitoring these factors will be critical for assessing next week's direction. As of February 22, 2026, gold is trading near $5,109 per ounce, posting solid weekly gains after finding support around the $4,988 area earlier in the week. Technically, gold remains in a broader uptrend on higher timeframes. Price action is consolidating within a rising formation, with $5,000 acting as psychological and structural support. Immediate resistance is located around $5,118. A sustained break above this level could open the door for further upside momentum. Momentum indicators on the weekly time frame remain constructive, although short-term charts suggest the market may be slightly extended and vulnerable to temporary pullbacks. Fundamentally, upcoming U.S. data, including PCE inflation, GDP revisions, and any commentary from Federal Reserve officials, may increase volatility. At the same time, geopolitical developments remain a key wild card. Looking ahead to February 23 through 27, the broader bias remains cautiously bullish, provided gold holds above the $5,000 support zone. Bullish scenario: a confirmed break and daily close above $5,118 could signal continuation toward the $5,200 to $5,350 region initially. If macro conditions align, particularly weaker economic data or escalating geopolitical tensions, an extension toward $5,500 cannot be ruled out, though that would likely require strong momentum. Pullback scenario: early week consolidation or profit-taking could bring price back toward $5,043 or even $4,950. This zone would be important to watch for renewed buying interest. Bearish scenario: if gold falls below $5,000 and the US dollar strengthens significantly, downside levels near $4,950 to $4,800 may come into focus. Overall, the outlook for next week is mildly bullish but likely volatile. Risk events could quickly shift sentiment in either direction. That's your gold market outlook for the week ahead. Do you expect continuation toward $5,500, or do you see a correction coming first? Share your perspective in the comments. If you found this analysis helpful, consider subscribing for weekly gold updates and structured market breakdowns. Trade responsibly, manage your risk carefully, and I'll see you in the next analysis.